Welcome to a brief introduction on derivatives. Some of you may already be familiar with derivatives, either in calculus or in financial economics or accounting. As the name suggests, derivatives are financial products which themselves do not have a value. Instead, their value depends and is derived from a different asset's value. And that is why they are called derivatives, because their value derives from the value of an underlying asset or security. We will begin with options. There are usually two kinds of options: call options and put options. Call option is pretty much the buyer's option, or the bull's option, or the optimist's option. Why? Because it gives you the right to buy the underlying asset at a particular price, at a pre-agreed price. That pre-agreed price is called the striking price. So remember, I mentioned it is the bull's option or the optimist's option. Why? Because this option becomes profitable only if your prediction is for a higher future price. So let's say if you believe Boeing's price in 3 months will rise up to $180 and it is currently being traded at $147, if you are able to buy a call option which will allow you to buy the stock of Boeing at $147 in 3 months from now, you can make money only if the price goes up. In other words, only if the bull market or the bullish stock becomes true, you make money. So you should buy a call option only if you're bullish or optimistic about that underlying asset. Now on the opposite end, with a put option, I mentioned this is the pessimist's or the bear's option. Why? Because you can only make money if the price goes down in future. So the opposite of call is put. You will be purchasing the right to sell the underlying asset. In the call option, we acquire the right to buy the underlying asset. In put option, we acquire the right to sell the underlying asset. So again, sticking with the Boeing example, let's say we acquire the right to sell Boeing at $147 in 2 months from now. So let's say after 2 months, the price slumps to $110. So in 2 months, if you hold the option to sell Boeing at $147, would you not do that? Yes, you would. Because the alternative is to go to the market and sell it at $110. But owning that piece of option gives you the flexibility to sell or to transact at a pre-agreed price, the strike price. But of course, these options do not come for free, because somebody has to issue them and somebody has to agree to take the other side of this transaction, carry the other end of this risk. So they will charge you a premium for this, and that is called the option premium. So again, to recap, call option allows you the flexibility and the right to buy the underlying asset in future using the strike price. And the put option, on the other end, allows you the flexibility and the right to sell that underlying asset at a pre-agreed strike price. But let's not forget, in both cases, you better be pretty good at predicting the future trend. Otherwise, you're only wasting your premium money. Now, as for futures, the most popular derivative product, it entails a contract between two parties, usually an investor and an exchange, that says a particular asset will be delivered in future at a particular place, on a particular date, on a pre-agreed price. And that price is called the futures price. And that price will have to be paid by the buyer on the maturity. So let's say we buy a futures contract for WTI oil, West Texas Intermediate oil. This future contract, let's say, matures on 25th of July. That means on the 25th of July, I will have to pay for 1,000 barrels of West Texas Intermediate American crude oil and that would be delivered to me at a particular depot or warehouse or a transportation facility or an oil tanker that is pre-agreed by the New York Mercantile Exchange. So as you can see, the underlying asset of this contract is crude oil. The amount is 1,000 barrels. The date is May 25th, and that is the maturity date. And the amount, well, that depends on the price per barrel. As I speak right now, WTI crude oil is being traded at around $22 per barrel. So if I buy 1,000 barrels in one contract, I would have to pay $22,000 plus some exchange transaction fees and probably some transportation fees as well. And that's the example of a very popular futures contract. Now this example was for a commodity-based futures. There are many other types of futures available as well, including stock index futures. You can simply Google for Dow Jones futures, FTSE 100 futures, S&P 500 futures, etc. You can have futures based on interest rates, such as LIBOR, based on currencies, such as USD, British pound, can have based on gold, other precious metals, such as platinum, palladium, copper, coffee, sugar. The underlying asset can be pretty much anything, but the contract remains the same. Now in futures and in other financial market situations, there are usually two kinds of positions. One is the long position, the other is the short position. For futures in a long position, you're agreeing that you will buy that piece of asset on the contract maturity date or the delivery date. But if you have a short position, you're agreeing that you will be delivering the underlying asset upon maturity. So in our example, we will be receiving 1,000 barrels of American oil. So we have covered options and futures. So let's recap some key differences between them. In the case of an option, for a call option, we acquire the right to buy. For a put option, we acquire the right to sell the underlying asset. And as the name says, it is an option, means we are not compelled. It is not mandatory that we exercise this option. Just having a call option does not mean I must buy the underlying asset on maturity date. I can still choose not to exercise that option or use that option. In that case, I will only lose out my premium money. But in the case of a futures contract, you must deliver or accept delivery. If you're in a long position, you must take delivery. And if you're in a short position, you have to hand over the goods in the right time. So it is an obligation. For the options, they're only exercised when they're profitable. That is, the option holder would exercise the option only if it makes money. In our Boeing example, we have a call option to buy Boeing at 147. So let's say in 2 months, the price goes down to 110. Would we exercise our call option? Why exercise the option and buy something for 147 when I can simply go over to the regular market and buy it real time for 110? This is an unprofitable option, so I should not exercise. I probably paid about $3 to $4 as a premium, so that $3 to $4 would be my loss. But if I exercise, I lose out not only the premium of $3 to $4, but also an extra $37 because I can simply scoot over to the market and buy at a much cheaper price. Unfortunately, with futures, we don't have this option. It is an obligation. We must either buy or deliver. Another difference between them is that an option can be bought just by paying the premium price. But for futures, no such premium is charged. The price of the contract itself is the price of the futures product. So that concludes our brief discussion on derivatives. We've looked at call options, put options, futures, long positions and short positions in futures, and key differences between options and futures. That's it for this topic for now. I will see you in the next video. Take care.